This segment sponsored by Foster Financial. Welcome to Money Monday with Foster Financial. Joining me today is Caleb Doane, their Vice President, and today we're going to break down some aspects of what you all know as the Big Beautiful Bill. Hello, Caleb.
Hi.
How are you?
I'm doing well. How are you doing?
Good. Okay, so nothing's really happened since the last time we spoke, right?
Right. Nothing at all. Right.
There hasn't been so much happening in Congress and just through them passing essentially President Trump's Big Beautiful Bill. And I know that there's different elements of it that affects people, their taxes, retirement, and all of that. So over the next couple of weeks, we're going to explore it, and you're going to bring us some really good information.
Yeah, absolutely.
Okay, so what will we discuss about the bill today?
Yeah, so one of the biggest changes in the bill that investors and taxpayers probably won't notice at all is the fact that the tax cuts from 2017 are getting extended. And so back in 2017, the 15% tax bracket got moved down to the 12% tax bracket. The 25% tax bracket got moved down to the 22%. And so at that time, people, noticed the reduction in taxes, which was really great to see for a lot of taxpayers. That had a specific provision in it that said, unless new legislation is passed, the tax brackets are going to snap back up to what they were before 2017 at the end of 2025, so kind of starting in 2026. So what this new bill did was, make those tax cuts permanent, and so, we don't have any sunset provisions in the new legislation. That 12% tax bracket will stay the 12%, the 22 will stay the 22 onward from here on out.
Interesting. So that's essentially what was put into place under Trump's first term.
Right.
And so now, 10 years later, we can just kind of stay what we're used to in that tax situation. And so when you say it won't sunset, can you break that down? What do you mean?
Yeah, so they're calling the new, extension permanent. And I kind of always put that in air quotes a little bit, because what that basically means is that there's no sunset provision in this right now, but new legislation can always be passed in the future, right? Just like this, was passed just in July here. So right now, under current law, there is no kind of projected change to the tax code. But theoretically, 4 years from now, we could have, a different president. We will have a different president in 4 years. There's going to be a new Congress. They could pass a completely new tax code that could change it. One of the things that, a lot of our clients will notice is that when we have reviews with them, we'll look at their projected cash flow into the future years of their retirement. And under the previous law, the taxes were set to change starting in 2026. And so we could see that they were getting charged higher taxes, and it was kind of reducing their cash flow in future years. Now we can change that, where they have these lower tax brackets for the rest of retirement. And so when we look at our financial plans, everything looks a little bit better now because there's, less taxes for the rest of retirement.
Yes. Okay. And so essentially, this is permanent unless an action is taken, so it doesn't expire.
Exactly.
So people don't have to worry about, this coming back up to vote on or having to be included in a future bill unless it is intentional to do so. So what would have happened if that bill wasn't passed with this extension included?
Yeah, so then, starting in 2026, everyone's tax brackets would kind of get moved up a little bit. People would certainly notice that their withholdings need to be a little bit more to not owe in at the end of the year. And that would impact everyone who's working, people who are in retirement. It would impact a lot of folks, because the 2017 Tax Cuts and Jobs Act was a very big tax cut across the board. And so allowing that to stay in place is a really, good thing for taxpayers. But it's something that, a lot of people won't really notice because it's just an extension of what they were already used to. From a financial advising perspective, we take a look at tax brackets when we're doing Roth conversions or, distributions from your IRA or harvesting gains on a non-qualified brokerage account. So these certainly impact how much we're willing to do every single year for clients, based on how it's going to impact them in retirement. So it certainly, plays a role in the financial advising aspect.
Yeah, and then as they are considering what to invest, how to invest it, you're saying that really affects how aggressive that they want to be or what their cash flow may look like, because now they know how much money will be taken out in the future. So when you see changes not being made to it and it being extended, does that allow some wiggle room? Do you see clients wanting to be more just free in their investment options?
Yeah, it certainly impacts the cash flow. And so, I mean, if we're projecting out, how much somebody's going to spend on taxes every single year, now that's a little bit less for these later years in retirement. So that can free up some money for people to, do extra things in retirement, just give them a little bit of cash flow and give them a little bit more wiggle room. So that's certainly a good thing for a lot of retirees.
All right, awesome. Well, thank you, Caleb.
Yeah, thank you.
Appreciate it. So we will be continuing this conversation. So catch Wealth Wednesday as we dive deeper into this bill. And remember, you can always reach out to Foster Financial. We'll have their phone number and website listed below, and I'll see you after the break. This segment sponsored by Foster Financial.